All right. What's going on, guys? So there's a Q&A button you can press. And today I'm, doing what we do each week on this, taking your questions, helping how I can, talking all things trading, whether it's psychology or strategy or a recent sequence or, whatever you want to talk about trading wise, risk, trade management. So just submit it via the Q&A box, and then I'll click them and answer them. You'll be able to read them and whatnot yourself. So for example, we'll answer this live. Duru says, I found myself often chopped up when some bar-to-bar overlap happens, and I also don't know how to scratch effectively. So what do you think about having a larger stop loss based on micro trading time frame rhythm when having entries around choppy areas like the middle of DVAs or value areas, going with momentum shift stop loss at clean areas? Yeah, so you're definitely onto something there. First of all, anytime contextually you find yourself not having something to lean on in terms of a reference or an ideal trade location, as we call it, then you're subjecting yourself to more chop, right? You gave a perfect example there, such as when you're in the middle of a value area, you don't have anything to lean on, and price tends to be messier in those areas, as opposed to trading from the edge of value where you might secure a better trade location and not have to deal with as much chop at your entry price. It may chop once it starts working, right? But that's beside the point. So I think that's a good approach. It's not the only way to do things, but it's a good approach. You kind of said, well, if I'm having trouble with this, first of all, try to get better trade locations. That's step one. Second of all, if you are going to continue to trade from some of these areas where it's chop, then absolutely a wider stop. Keeping in mind that you may need to give it room to run stops, right? If you've got a little choppy zone that you've kind of entered in, for example, you're long from here. Well, don't just say, well, I'm not going to put the stop anywhere inside this chop zone, right? Don't just put it right outside it, because guess what we all know happens? That, right? You don't want to be that guy. So if you are going to put it outside a zone like this, you really need to give it some room. Otherwise, this brings into the equation here the art of the re-entry, as we call it. So even if you do get stopped or whatnot, and this thing sets back up, right? I think re-entries are really important. And that goes beyond the scope of even what we're talking about here. Just in general, they're very important. Another thing to consider is to actually, once you identify chop, and let's say it's before you ever enter, but you are interested in entering, get rid of the micro trendline break stuff, because that's a demand of direct momentum. One great way to trade once there is existing chop is to actually wait for a stop run to occur, right? And you use that stop run to get you into that position. So in the case of the example we were looking at just a moment ago, right, you would use some pattern like this right here to start to get in, right? So you look, maybe you read order flow as this is happening. How strong are these sellers? How strong are these buyers as they start to lift it back up? And you could either get in somewhere back in here as we re-enter this range. You could get in somewhere here again, now using something like a micro trend line break or momentum shift, because now the expectation is that you have something to lean against here and you have excess created, right? Right at your back. And that is actually a good stop placement there as well, right? If you wanted that wider stop, right? So if it's market profile, right, it's going to be looking something like this, right? And all of a sudden, boom, we get this one that breaks through this area. And then either during that 30-minute period or on the next one, let's say, right, it starts to look like this. Well, guess what? Now I can use this excess that we have on the day, right, from here to here. We can use that excess as a reference for risk. So if you get involved somewhere, anywhere in here going forward, well, now you just need this excess to hold, right? It might kind of test into it a little bit, but you need a couple ticks of that excess to remain. Great question. Graham says, hey, Merritt, I'd like to ask a question about context, if I may. Within Jim Dalton's book, Mind Over Markets, he mentions use TPO count on the developing profile to understand imbalance that occurs within the developing value area. Can you get consistent, repeatable information from his method? Honestly, I don't know a whole lot about TPO count. I really don't. So that's just something unfortunately I wouldn't be able to answer. So TPO count is how many total blocks or letters there are, I believe. And so if you have a high TPO count, but a smaller range, well, that's actually an indication of balance, right? If you have, range expansion occurring, I just don't see much of the value in TPO count. Personally, I'm sure there's, use for some people. I just think you use the profile and the information that it's showing you. And for example, here's a great example. Let's say we have a profile that looks like this, right? It's a big old fat distribution. Well, all of a sudden we start to break, right? And we retest and we kind of hold it and we start to go like this, right? Classic type of shift from balance to imbalance within one profile, right? Well, if you use the TPO count, divided by the range or whatever, and start to determine what this profile is doing, you miss the boat because you don't understand that there is a shift in the current day's condition, if you will, right? When we had the break from that established balance. Stick with basics like that and a lot of this other fine-tuning, additional granular type variables and stuff, I think you end up not needing. Tibby says, hey, Merritt, why did you find the W-PVAH neutral on ES Monday's DMI? I saw a W-PVA RPB and used W-PVAH as a strong bear level. Maybe I'm missing something. So let me try to refresh myself here. So we said Monday, right? Monday. Oh, I remember. Yeah. So the W-PVAH, again, I don't like to talk about these things publicly, right? So I'm just going to continue to use these acronyms, and some people are going to be confused, and that's fine. It was already the key recent rejection from the overnight high. So you have to ask yourself, yes, that was a bearish rejection, but how bearish is it if we just go up there and revisit it quickly right away? And by the way, there was no shift in condition on that time frame. It was just a test from inside to the upper edge there. So it's not a strong bear reference. And my take was that if we got right back up there, it weakened the reference. So I liked it as neutral. Hope that helps. The best way to do that, Tibby, is to ask within our community. We have a thread where anyone at any time can say, hey, you did this on the DMI. What do we think about it, community? Hey, let's bring Merritt in here. What could he explain something, right? Mason says, hey, could you explain your usage of ETH versus RTH VWAPs? What's the relationship between the two? Much thanks. So essentially, Mason, they're different time frames, right? Essentially, that's the only difference. It's a developing value area is how we use them. So imagine that on this spectrum of time from, the exchange reset all the way through the next one. And we have, sorry, this is not going to be to scale. I'm not going to rack my brain around it. We have the 8:30 pit session open, and we have the 1500. All these are central times. Pit session close. So what if you ran a profile from the start of the Globex session, right, all the way through, let's say it's currently, 12 o'clock, and you ran it all the way to there, right? You would have a certain profile with information that started here and ends here. What if you started a profile at the pit session open, right? And you ran it and collected all the information, and it made a profile, right? Obviously, these two wouldn't be not overlapping. It's just a simple example here. But that's all it is. So imagine we start a VWAP from here, right? Imagine we start a VWAP from here. So it's just a different amount of time frame that's going into the data set that gives you the plot of the said indicator. That's all it is, right? So a lot of people don't just grasp that like common sense knowledge as to like RTH versus ETH. They get too focused on the indicators themselves and like what kind of magic is each one of them and all this kind of stuff, right? It's just one collects it over a longer period of time. One only shows pit session. In terms of my usage, I almost exclusively rely on the full session one. There are certain conditions, such as when you've had a huge overnight move and that VWAP, DVAs and stuff is just way really expanded. Then you get to the pit session and you start to, get something like this. Well, I'm going to start to lean. I'm going to look at that RTH because this ETH is just absolutely ginormous. There is no relationship, again, it's just like what data sets are comprising each calculation. You can use them in like confluence and understand where they're dissonant, right? One could be offering one of our trade access type setups, and one could be saying that's a horrible idea right here, right? Or one could be saying this is an extreme fade, and the other one could be retesting VWAP, right? Both of them from above or something. And that adds like a layer of confluence for that intraday trade location. Hey, Merritt, do you trade light in the sessions leading up to FOMC? Do you even trade these sessions at all? I trade normally. I wouldn't say light. Obviously, as we get closer and closer to FOMC, I'm less inclined to put on a new position because things will tend to quiet down. And then all of a sudden I'm left at like holding all the risk as the, news catalyst is about to hit. But I'll treat the morning session pretty normally. I tend to kind of, the only adjustment I make is essentially a tampering of expectations for like trade management. I'll tend to be a little quicker to take profits because more times than not, I'm going to end up flat into the number. So I'm not going to sit there holding 75% of my position for a core position runner that I just hope goes a long, long ways pre-FOMC, because that just doesn't tend to be the tendency of the movement, right? So it's more of a trade management adjustment than anything. I don't trade light. I don't change risk. I don't, do anything like that. Kevin says, for your narrative today, were you bullish on the year chart? I was, but I noted it broke. I'm guessing you're talking about the S&P, Kevin. No, it's still bearish. It needs to be still bearish. I understand it's a difficult one to read. But I would call any bullish read on the year time frame as micro, in my opinion. Pretend for a moment that's an intraday chart, right? Pretend that you're just looking at ETH VWAP and yesterday's value. Is this a short here or is this a long? And the answer is it's a short. Andre says, why were you starting to lean bearish the last couple of days, despite the appearance of acceptance into previous yearly value and previous quarter? So the quarterly is absolutely bullish. I've got it as a bull level on my charts. I don't know that I've been strongly leaning bullish or bearish the past few days, guys. In fact, I've had a bull zone on my most recent, not a bear zone, a bull zone on my most recent DMI. So I'm not sure really where you're figuring that from, Andre. The DMI I put out, was it yesterday? I think it was yesterday. I had a neutral zone higher and I had a bull zone lower. Now I've been bearish today because we broke down that bull zone, right? I mentioned yesterday my read on the S&P was going to essentially be the same unless something drastic happened coming into the session, and the overnight session was super quiet. So nothing changed really. What happened today, we got into the bull zone. I liked the longs initially, and then we broke it down, and you want to be bearish going with that fresh breakdown. So as far as you know, I my analysis and stuff that I've put out, I've been more bullish than bearish. Oh, let's see if I can get this name right. Govindaraj. At present in ES, when I enter breakout pullback after a breakout, as per price action or swing stop, I don't know what a swing stop is. It takes around a minimum of 10 points. If I have to go for 2R, then it has to be around 20 points. Even if I go for 10 points for reward, most of the time the market doesn't go there, as my entry itself will be around 10 points from the low of day. It's mostly I'll be entering stop limit, blah, 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 blah. Even if it goes there, then that type of swing trade setup occurs at max 1 or 2 times a day. What is your view and how should I enter? Man, I'm afraid I don't understand this question at all. First of all, don't get so attached to 1R, 2R, 10 points, 20 points. You got to stop that right now. Look at the market, assess how far away the stop needs to be. And if it's 2 points, it's 2 points. If it's 200 points and you've got the risk to do that, then it's 200 points. It's not 10 points all the time or 20 points. You're just attaching that to recent volatility and making it, easy. Your reward also should be something that is unique, that you're going for, that the market generated information is telling you is on the table and open for profits, not just going for 10 points or going for 20 points. So let me read through this question one more time and see if I can figure out what I could answer. No, sorry, I don't understand your question. You could rephrase it in the Q&A again. I watched Credelli's video on VWAP. I was wondering, can you use intraday VWAP to get context on shorter time frame? Example, you compare the previous value area if the price is currently trading above it on a 3-minute chart. Would this be the same as bullish context since it's trading above previous value? Sure. Then only look for longs as it's within your risk. Absolutely. I mean, there's a lot of traders who, use that, even VWAP based previous value, as you mentioned, rather than what I prefer, which is, market profile or volume profile, kind of looking at where the actual trade was, whether it's time spent or volume traded. I think that's a little superior to VWAP based value. But, a lot of days they're really close, so a lot of days it's not going to be that much different. It's trend days, imbalance days, where those two tend to get very different. So anyways, sure, you can use that as context. If you're a super short-term scalper, you might use developing value as your context, and you might do a bunch of other stuff inside of that framework. So what's context to one person is, a timing tool to another person. There's a bunch of it's all relative. So it depends on your how you're kind of putting together your time frames to you know, it's just important that everyone has the formula of a higher time frame which sets context, and then a trading time frame in which you look for ways to access and define maybe momentum and rhythm and what trade is potentially setting up, and then perhaps a lower time frame to help fine tune entries, to potentially place risk if you want shorter term risk placement, to, you know, read order flow. That's like a lower time frame tool. You put those three things together and you can do some good stuff with markets. Mason says in ES today, both the quarterly monthly DVA broke under their +1 VWAP. Would that shift you away from the bullish read, or how would you treat that situation? Maybe turn to more neutral, less bullish. So today for me in the S&P, you know, it's not all about the VWAPs really. It's more so about a nice multi-day balance and the fact that we broke down from that balance. You know, we had some confluence with some of the VWAP locations at the lower edge of that balance. So that just added to that read, right? So A, B, C period breaks down, D period gives the retest, and it's off to the races lower, you know, headed for some lower targets and stuff like that. But you know, we'd have to get into a whole heck of a lot of detail to talk about what type of break under +1s or whatever changes our what we call read on acceptance and current market condition on that time frame, and therefore implications with our laws of market dynamics and what we expect, you know, currently is happening. Therefore, key recent rejections, likely destinations, all those implications that we have for that. Yeah. Some traders say that your P&L is 80-90% from only 10% of your trades. Do you have a similar experience? Pretty close to that. Yeah, it's actually surprising. You know, if you look at your month or you look at your quarter, a lot of times it's some of those really big handful of like really high quality winners, multiple R's that you got. That's kind of accounts for essentially your net P&L that you got, you know. I think that's true for most traders. Just by nature, right? You end up with a lot of trades where you maybe stop out, and then a couple other trades, you get like a scale out and a stop, or two scales and a stop, and then you have another full stop out, and and then you have one big winner, right? And then you go through that entire cycle again. And guess what? At the end of all that cycle, if you repeat it 20 times, you end up with, you know, 50 trades that were stop outs, 50 trades that were scratches, 50 trades that were like 1R, you know, gains because you got like a 2R scale and then a stop or whatever. And then there's those big winners, right? Just a handful of them. And yeah, so I think that's true for most traders that I'm privy to their you know results. It's a great concept because I think knowing that's true for most people, knowing that, it kind of arms you with a little bit more stronger mental framework, allows for, let's call it mental toughness, allows for the quote unquote dealing with the adversity of grinding through the slop of the large amount of results that don't really pay you anything, right? All the stops and scratches and tiny wins and tiny losses and blah, blah, blah. Well, if you know that it's kind of part of your job to just grind through that stuff, and that over time, and that eventually, if you allow trades to work that are working, and you have the process and the mentality to allow open P&L to come back and disappear on you, right? You have to do that if you want bigger winners. You can't have it both ways. You can't tightly protect all your profits and get big winners. It doesn't work. That does not work. Trust me. So knowing that, arming yourself with that information, it's kind of like part of one of the tenets of the evolved human trader, the mental framework that we talk about in the NADRO course, is around knowing your job as a trader, right? I try to arm people with like, here is your job that you're supposed to sit in your seat and you're due. Here's what trading really is, right? It's not what you kind of maybe fantasize that it is. Here's what it really is. And so that would fit into that, as your job is to be there for the moments that, and allow the moments that really work to work. And the rest of the time, you're almost going to kind of break even over a lot, the bulk of your trades over 1 month, over 1 quarter, you know? So that type of stuff can even help your mentality. Amir says, hi, Merritt. By market profile, volume profile, you are able to define some levels that the market may react to them. And regarding its reaction, you guess what would be the next move, but how do you measure market strength? Well, first of all, I use market profile to tell me what is happening. Not that they might react to them. I look that they do react. And if, and only if they do react, and it's a current condition, whether balanced or imbalanced, then I know what my directional bias should be. I know if this continues to persist, what is currently is. If it persists, then the market will attempt to test XYZ, another reference, right? We understand how markets move. So it's not that we predict, oh, I'm going to use market profile. I predict that we'll react from here. That's not what we do. And so then the second part of your question, how do you measure market strength? I then go to lower time frames. I'm analyzing what the intraday condition is, whether we're trending, whether we're rotational, what the momentum is like, what the speed of the tape is like, what the order flow is behind the price action and the movement, what type of price action patterns are we seeing. That's how I measure market strength. For beginners, which type of entry order do you advise? Limits, stops, markets? I mean, it's a good question. I think it's simplest and cleanest to just use essentially market orders, to not try to place a limit. And especially for my students, because we look for a shift in momentum. And when we see that, we want to be in now. Now's not the time to try to work a limit order and save yourself a few ticks. It's not worth losing 3R, right? And by being left in the dust, because that momentum is present, you better be in, you know? So, you know, I'm kind of speaking from how I teach people, that market orders are quite simple. Just press the button when you're ready to be in. Now, let's not overly concern ourselves with maximizing efficiency of saving a tick or two here and there, especially for liquid futures markets. If it's a wide spready stock, you know, or ETF or whatever, then, or options, yes. I mean, we're not just going to bang in with market orders. We're going to try to at least work the midpoint, you know, or whatever. So it depends on what you're doing. But for liquid futures, and what I teach NADRO traders is just to keep it simple. Let's use market orders and let's not overthink this. Ryan says, would you hire me for your desk if I trade on Renko charts? That's funny. We kind of have like a long-standing joke on Renko charts, which I'm only halfway serious about, by the way. Yeah, you know, I would, if if your risk adjusted results were good enough, you know, if you passed the tryout and you were a Renko guy, I would hold my nose and hire you. Good question. Brian says, do you ever use prior volume point of control levels on higher timeframes from monthly or years back, or do you think these volume areas become irrelevant after a certain amount of time has passed? For example, this week we went through the 12,300 level on NQ. This level was important on the daily chart from the September 20th to March 2021. I have two higher time frames currently that I have volume profiles on. One are weekly volume profiles and one are yearly volume profiles. The weekly I tend to use as a gut check whether prior VWAP based value is high quality or low quality, because I want it to align with where there was balance or edge of balance. The yearly one, I look at kind of essentially LVNs, or again, edges of balance that may offer some additional long-term levels. You know, for example, I had one around 3,700 in the S&P, right, which was below any standard long-term VWAP reference I had on that time frame. I had that you know, edge of balance, that lower edge of a nice big volume node from last year down there. And, you know, sure enough, that was, you know, low of year for this year. So those can be very, very useful regardless of the time frame, right? It doesn't matter. Again, it's like someone else asked about, hey, could you use this for context? Well, sure, you could use a custom composite, right? Like some people use from like a major swing high or swing low. You could use VWAPs, anchored VWAPs from those fractal points. You could use a yearly volume profile. You could use yearly VWAP. You could use monthly volume profile. You could use monthly market profile. You could use monthly VWAP. You can use all kinds of things to frame context. They all work and they all lie to you and don't work sometimes, right? That old trading phrase of everything works and nothing works. NADRO works so well because it is a beautiful, holistic view of the market. It's not just, hey, this is like my key indicator and on this time frame, and that's my context. No, we try to garner like what is the through ranking and distilling of information and learning the skills of identifying which references are telling us that they are important and impacting the market's direction and you know, risk reference and all this kind of stuff. And we try to look at essentially 5 time frames and determine what the cohesive view is. What are the majority of those time frames telling us? Do they agree with each other? Do they disagree? Where do they agree? Where do they disagree? Because often there's a bit of both. And when we rank and distill all that information, what spits out is kind of the DMI. Here's what I'm seeing is most important. Sure, a lot of times there's some things that don't agree with that, but by and large, here's what the timeframes are telling us, right? That's what we do with NADRO. And then we drop down to a trading time frame where we assess its current market condition and have ways of setups of accessing narrative-based ideas, right? Contextual ideas. And then we can analyze, like I mentioned to someone earlier, the strength of the market, right? All the way down to order flow and whatnot, and helping me make good decisions short term within this top-down approach of trying to trade a contextual narrative. All right. Awesome questions, guys. Hope you had a good time hanging out. I know I certainly did. I promise we're going to have this chat thing fixed so we can talk a little more for next week. Cheers. We'll see you guys around. Thanks so much.